Phew. Well, hello there.
Hello and welcome. Today, we're going to tackle a really important topic, how companies report and analyze their financial obligations, what we call liabilities. We'll start with the absolute fundamentals, the building blocks, and then we'll work our way up to the more complex analysis that you'd see from professional investors and creditors. It's going to be a deep dive, so let's get started.
Okay, here's our roadmap for our discussion. First, we'll nail down exactly what a financial obligation is. Then, we'll get into the nitty-gritty of accounting for everyday liabilities. After that, we'll move into the world of notes, loans, and interest. Then, the big one, the mechanics of bonds. And finally, we'll bring it all together to see how we can analyze a company's debt.
All right, first things first. We're starting with the absolute foundation of debt, defining financial obligations. Before we can analyze anything complex, we have to be speaking the same language. So let's establish a really precise definition of what a liability actually is in the accounting world.
So here's the formal definition, and every word here matters. A liability is a present obligation, so it's something owed right now. It has to arise from past transactions, meaning something already happened to create this debt. And here's the key. Its settlement is expected to result in an outflow of resources. Usually that means cash going out the door. So think of it this way. Past event, present obligation, future sacrifice. That's the trifecta that defines a liability.
Okay, but not all liabilities are the same, right? We have to make a really important distinction, and that's between current and non-current. It's all about timing. A current liability is anything that needs to be paid off within 1 year, using current assets. Think short-term. Everything else, all those other debts that stretch out beyond a year, we lump those into non-current. This distinction isn't just academic, it's absolutely fundamental to understanding a company's financial stability, especially in the short run.
Okay, let's move on to Section 2. Here, we're getting practical. We're going to look at accounting for daily liabilities, things like sales tax and payroll. This is where the rubber really meets the road for most businesses.
Let's walk through a classic scenario that every retailer deals with. Imagine a store makes cash sales of $25,000. Now, in this case, there's a 13% HST. The crucial thing to understand here is that the retailer isn't just collecting money for itself. It's also acting as a collection agent for the government. That sales tax money was never really theirs to begin with.
So how does this look in the books? This is where it gets interesting. Look at the journal entry. The company's cash goes up by the full amount, $28,250. But, and this is the key part, the sales revenue is only $25,000. That extra $3,250, that goes into a liability account called HST payable. It's a debt. It's money the company is holding that it owes to the government. And because it's due soon, it's a current liability.
All right, let's make this a little more personal for a second. Think about your own job. If your gross pay for the week is $600, is that what you actually see in your bank account? Of course not, right? We all know this. Well, that gap between what you earn and what you take home is all because of payroll liabilities that your employer has to manage.
Okay, let's blow this up to a company level. Look at this payroll entry for $25,000. The total salaries expense for the company is indeed the full $25,000. That's their cost. But look at the salaries payable. That's the net pay going to employees. It's only $17,352. So where did the rest go? It's split up into several other payable accounts. CPP payable, EI payable, income tax payable. Each one of those is a separate current liability, a separate debt the company owes to the government on behalf of its employees.
And you know what? It doesn't even stop there. This is so important. The total cost of an employee is way more than their gross salary. The company also has to pay the employer's portion of CPP and EI, and then you have other costs like workers' comp or maybe health insurance benefits. All of these are additional expenses for the company, and they create even more liabilities that have to be tracked and paid off. It really adds up.
Moving on to our third section, we're shifting gears a bit from those day-to-day operational liabilities to the ones that are all about borrowing money, notes, loans, and interest. This is all about the cost of borrowing. Before we can talk about interest, we have to be crystal clear on what we mean by principal. The principal is simply the original amount of money that was borrowed. It's the starting point. All the interest that gets charged over the life of the loan, it's all calculated based on this principal amount. So it's a critical number.
Okay, let's walk through a simple loan step by step. Let's say on March 1st, a company borrows $250,000. Step 1, cash comes in and a bank loan payable is created on the books. Simple enough. Now, step 2, at the end of March, even though no payment is due yet, the company has to accrue the interest expense for that month. In this case, it's $625. We have to recognize the expense as it's incurred. Then step 3. Come July 1st, maturity date, the company pays everything back, the full $250,000 principal plus the total interest that is built up, which would be $2,500.
But now let's look at a more common type of loan, an installment loan. This is different. Each payment is a mix of two things, interest and principal. So look at this first payment of $4,717. Part of that, $1,042, is just to cover the interest for the month. The rest, the other $3,675, actually goes to pay down the loan balance. So after just one payment, the new loan balance is already down to about $246,000. You're chipping away at the debt with every single payment.
So why would a company take on debt? Well, it's a classic trade-off. On the plus side, you get the cash you need without giving up any ownership of your company, unlike selling stock. Plus, the interest you pay is usually tax-deductible, which is a nice bonus. But there's always a but. The downside is you are now legally required to make those principal and interest payments, no excuses. And you're exposed to risks like interest rates going up, and you might even have to put up collateral. It's a balancing act between opportunity and risk.
All right, let's level up. For our fourth section, we're diving into the big leagues of corporate finance, the mechanics of bonds. This is how massive corporations, and governments for that matter, raise huge amounts of capital.
Now here's a fantastic question that really gets to the core of how bonds work. Why on earth would anyone pay more than face value for a bond? I mean, if a bond has a face value of $500,000, why would you pay over $522,000 for it? It seems like you're guaranteed to lose money. But the answer, and it's a brilliant one, has everything to do with interest rates.
This table really breaks it all down. This is the time value of money in action. A bond's price today is nothing more than the present value of all the cash it's going to pay out in the future. You've got two streams of cash, the big lump sum principal repayment at the very end and the series of smaller regular interest payments along the way. You calculate the present value of both of those streams and add them together. That's the price. Now, in the specific example on this slide, the math works out perfectly to $500,000 because the bond's rate matches the market rate. So back to our question. A bond sells at a premium, that is, for more than its face value, when its own interest rate, what we call the coupon rate, is higher than the going market rate. Think about it. If this bond pays, say, 5%, but new bonds being issued today are only paying 4%, then this bond is a better deal. Investors are absolutely willing to pay extra for that higher stream of interest payments. That's what the premium is. It's the price of getting a better-than-average return.
And that brings us to our final section, number 5, analyzing a company's debt. This is where we put it all together. We know what liabilities are, we know how to account for them, so now what do the numbers actually tell us about a company's financial health?
When we analyze debt, we generally look through two different lenses, using two categories of ratios. First, we have liquidity ratios. These are all about the short term. Can the company pay its bills that are due right now, this year? Then we have solvency ratios. These take a much longer view. They're about the company's long-term survival. Can it handle its total debt load over the long haul? Now, let's look at a couple of really important solvency ratios. These two work together beautifully. First, you've got debt to total assets. It's a simple idea. What percentage of the company's stuff, its assets, was paid for with debt? The higher that percentage, the more leverage and generally the more risk. But then you have to ask, can they afford that debt? That's where the times interest earned ratio comes in. It measures how many times over the company's earnings can cover its interest payments. A high number here is great. It means there's a big cushion of safety. So I want to leave you with a final question to think about. We know that all the nitty-gritty details of a company's debt are disclosed in the notes to the financial statements. So if all the information is there anyway, does it really matter how we classify liabilities as current or non-current right on the face of the balance sheet? Does that classification actually add value for an analyst or an investor? It's something to ponder. How much does presentation and classification matter when it comes to truly effective financial communication?